Last year, we saw EPS beats for the big banks on almost every quarter, and yet share prices declined. So do the earnings matter at all this year?
Yeah, this week we might get maybe the opposite. I think expectations are extremely low for bank stocks. As I'm sure you know, given last year's rout at the end of the year, we had stocks in December that were pricing in recession-level PEs. We're up a little bit off those lows right now today in the banks, but I think expectations are low going into next week.
And if it comes to it, do you think that they would deal better with a recession this time round? And is that roughly where the valuations are, that they're expecting a sort of worst-case scenario?
You know, our bear case outlook, and let me just frame it a little bit better. We have a bull, base, and bear case outlook for all of our stocks that we cover. And our base case is not a recession. Our bear case is a recession. And the bear case that we're looking for is a corporate credit recession a la 2001, 2002, not what we had in 08, which was an asset deflation cycle. So it depends. Your question is, do they fare better in the
Sure.
next recession, whenever that is going to be?
But even
definitely versus 08.
Even in your bear case scenario, are they still attractively priced?
Our view is that there's like 85% of that is priced into the stock today. So, to be clear, in a recession, if we had a recession, it started tomorrow, yeah, there's a little bit of downside to our stocks that we cover. In particular, median for the group, maybe 15–20%. But on the flip side, recession does not happen over the next 12 months, and we have 20% upside for the group, 30% for our overweight rated names.
Let's talk about those overweight rated names. Of the big caps, you like Bank of America a lot?
Yeah, our top picks, B of A, JP, State Street.
And why BAC and JP Morgan?
So the key reason is that, macro aside, we're looking for institutions that we think can deliver positive operating leverage. Bank of America has been showing that in spades, in particular in their consumer business. We think there's more they can do there. And JPM is on a roll for market share gain in a variety of different businesses in a very positive operating leverage way.
So Betsy, when I look at this is Steve Grasso, when I look at the yield curve and the flattening of the yield curve, it seems like that's the only thing that you should count into factoring whether you buy the financials or not. And then when I look at Citi, which has outperformed, it's been one of the out-of-favor banks, it means that it's short covering to me. Why do I have it wrong?
Well, I think there's a lot of different inputs. Obviously, the yield curve is one of them. When it comes to the yield curve, one thing I would remind people of is that banks don't just match fund. They fund with deposits. They fund with net interest-bearing deposits. So like 20% of their funding is actually, not costing them anything. So there is still positive carry in a flat yield curve environment. For Citi specifically, though, as I'm sure you're aware, they have a link with emerging markets. And as you've seen, a little bit of dollar weakness, emerging markets doing better, that typically bodes well for Citi stock.
What's your rating on Goldman Sachs? Big share price decline last year, but of course a big Malaysia-related issue hanging over them. We
have an equal weight rating on Goldman right now today.
And what's the sort of view on its valuation if it does get through the 1MDB scandal without a fine bigger than whatever size you've got written in?
Yeah, so I would just highlight that for our base case, we have, a little bit of a fine in there. I mean, basically what we're looking at is, and it's in our published model, it's below the line, it's not in our published, it's in the reported numbers, not in operating. And our expectation is that if the bull case for Goldman is if we get through the 1MDB, as you indicate, with very little reserving in over and above what we've got in our model, that yes, it's very reasonable.